There's something that will make you uncomfortable. Right now, if you own an index fund, an S&P 500 ETF, a 401k, anything like that, you own a stock that's up 523% and a stock that's down 54%. At the same time, in the same portfolio, one is Micron Technology, the other is Nike. Same index, same time period, completely opposite outcomes. And most investors have absolutely no idea this is happening inside their portfolio. The surface looks fine, the headlines look great right now. The S&P 500 is up around 9% this year. The Nasdaq is approaching all-time highs. About 84% of S&P companies beat their profit estimates last quarter, the highest rate since the 2021 boom. Everything looks fantastic on the surface. That's exactly where the danger is. Because underneath those headlines, a completely different story is playing out. I track 150 industries across the U.S. stock market every single week. Right now, 64 of those industries are declining. Money is actively leaving them. More industries are falling than rising even while the index sits at all-time highs. The rotation nobody's talking about, what's happening right now, is not a crash. If it were a crash, everything would be folly. Engie together. What's happening is a rotation. Think of the entire market as a swimming pool. The total amount of water stays the same, but one end is getting deeper while the other end is draining out completely. The index being at all-time highs tells you the pool is full. It tells you nothing about where the water is going. Energy stocks are up 28% this year, best performing sector in the U.S. Healthcare is down 6%. Financials down 6%. Tech up 16%. Materials up 14%. Same market, completely different outcomes depending on where you're positioned. Three things driving this shift. First, inflation is back. CP1 is currently sitting at 3.8%. The Fed's target is 2%. Energy costs are up 18%. Gas is up 28%. You're probably already feeling this. When inflation runs this hot, hard assets and commodities win. Paper-based assets lose purchasing power. It's not complicated, it's just history repeating itself. Second, there's almost no new money left to enter the market. There's a metric called NAIM. It's a survey of professional money managers measuring how much of their clients' money is currently invested in stocks. Right now it's sitting at 97 out of 100. Picture musical chairs, 97 pages. People are already seated. There are 3 chairs left. When nearly everyone is fully invested, there's no new buying pressure to push prices higher. What matters now isn't whether more money comes in, it's where the existing money moves. Third, real wages are negative. Real wages means what you actually earn after accounting for inflation. That number is currently negative. Americans are getting poorer even as their paychecks go up because prices are rising faster than pay. Every consumer-facing industry, retail, advertising, anything depending on people's spending is quietly bleeding because of this. Where the money is flowing, the winners. Let me walk you through the specific sectors and stocks that are attracting capital right now. Gold is sitting around $3,400 and is up nearly 50% over the past year. 3 forces are driving it. Central banks globally are expected to buy around 1,000 tons this year. China, India, Turkey, Saudi Arabia, they're all converting dollar reserves into gold. Cash is losing value guaranteed. Gold is the oldest inflation hedge in human history. A stock worth looking at here is Newmont, ticker NEM. Largest gold miner on the planet. Over $100 billion company. Not a speculative bet, this is a blue chip in the gold space. And gold miners through the GDX ETF are actually outperforming gold itself right now, which historically signals more upside ahead. 2. Uranium, this one is flying under the radar and shouldn't be. Uranium is up 21% compared to a year ago. China has 60 nuclear reactors running and 38 under construction. The U.S. just classified uranium as a national security asset. Tech giants Microsoft, Google, Amazon are signing contracts for small modular nuclear reactors to power their data centers. The U.S. needs about 50 million pounds of uranium per year. It produces about 1 million domestically. That's a 98% import dependency on something the government now calls a national security critical resource. The ETF URA is up 25% this year. Junior miners up 45%, but the stock I'd focus on is Cameco, ticker CCJ, $50 billion company, largest uranium producer in the world. If nuclear is the fuel of the AI era, Cameco is supplying it. 3. Copper is what oil used to be for the 20th century. Every electric vehicle needs 4 times more copper than a gasoline car. Every solar panel, every wind turbine, every data CE, intermittently, every power grid upgrade, all of it runs on copper. Bloomberg is projecting a 1 million metric ton deficit, meaning demand is already exceeding what the world can produce, and it's getting worse. Supply problems in Indonesia, Chile, and export restrictions from China are tightening supply further. Copper is up about 40% over the last year. The stock closest to a pure-play copper investment is Freeport-McMoRan, ran ticker FCX, around $80 billion market cap. When copper wins, FCX wins. Southern Copper, ticker SCCO, at around $160 billion, is also well positioned if you want something larger. Energy is the number one performing sector in the S&P 500 this year, up over 20%. While everyone debates whether tech is overvalued, energy has quietly outperformed everything. And it makes logical sense. Inflation is largely driven by energy costs. The companies producing that energy are printing money. A stock worth examining here is Total Energies, ticker TTE, $160 billion diversified energy giant covering oil, gas, and renewables. Capital is flowing into it consistently. The infrastructure boom attached to this, when commodities run, infrastructure and defense typically follow. Low. The numbers here are striking. General building contractors, non-residential construction up 330% as an industry. Electronic components up 300%. Engineering and construction companies up 200%. Water and sewer pipeline companies up 200%. Semiconductors up 170%. These aren't meme stocks. They're not crypto. These are companies physically building the next infrastructure of the United States with real contracts, real earnings, and real profits. Every tech company is spending tens of billions on data centers. Those data centers need chips, power systems, cooling infrastructure, copper wiring, and physical buildings. All of that spending flows through these companies. Specific names worth researching. Broadcom, ticker AVGO, supplies custom AI chips to Microsoft, Amazon, Google. $1 trillion plus market cap. Capital flowing in consistently. Comfort Systems, ticker FIX, an engineering company handling mechanical and electrical systems for data centers. Up 500% from its lows. Most retail investors have never heard of it. Seagate, ticker STX, data storage, $90 billion company, major winner in the AI infrastructure build-out. Celestica, ticker CLS, electronic manufacturing, NG, for cloud and AI hardware infrastructure, up 700%. Mastech, ticker MTZ, infrastructure construction, power lines, pipelines, direct beneficiary of the reshoring and infrastructure build-out. Quanta Services, engineering and construction for electric power, oil, and gas infrastructure. Invisible to most retail investors, backbone of multiple megatrends. Defense, NATO spending commitments are rising. Europe is rearming. Multiple active conflicts globally. Defense backlogs are massive and spending is accelerating. Rocket Lab, ticker RKLB, space launch and defense technology, up 2,700% from its lows. $40 billion company. RTX, formerly Raytheon Defense blue chip, up around 69%. More conservative, but firmly on the right side of capital flows. The losers hiding in your portfolio. Now here's the part that should genuinely concern every index fund investor. Remember, 64 industries are currently declining, and these aren't obscure corners of the market. These are household names sitting in your ETF right now. Shoe manufacturing down 37%. Nike specifically down 54%. Professional services/consulting down 30%. AI is replacing what 200 consultants used to do, and the market, this pricing that in. Booz Allen Hamilton down about 50%. Publishing down 43%. Reuters down nearly 50%. Forest Products down 36%. Advertising down 29%. WPP, the world's largest advertising company, down 66%. You own all of these if you own a broad index fund. They are actively dragging your returns down right now. The real dollar impact, percentages can feel abstract. Let me make this concrete. Say you put $10,000 into an index fund 2 years ago. Today you have roughly $13,000, a 30% gain. That sounds fine. But if you had positioned that same $10,000 into only the climbing industries, the ones we just covered, you'd be sitting at $40,000, $50,000, possibly $60,000. And if you were concentrated in the losing sectors, your $10,000 is now worth $3,000 to $5,000. Your broker reports you're up 9%, but that 9% is a blended average of rocket ships and sinking ships. The gap between $3,000 and $60,000 is not luck. It's not timing. It's simply knowing where capital is flowing and positioning accordingly. The core argument, the buy the index and hold forever, strategy worked well in a different era when innovation was slow, when disruption took decades, when you could owe man in a great company and trust it would remain great. That era is over. Technology is disrupting industries faster than any previous point in history. The company that was dominant 5 years ago can be structurally obsolete in 3. AI alone is reshaping entire sectors: consulting, publishing, advertising, professional services in real time. The index fund puts you in everything, winners and losers equally, and then calls that diversification. Institutional investors, hedge funds, the big money, they do not buy and hold. They track where capital is rotating and they move with it. That's not a secret. It's just not what they teach retail investors, because a passive buy and hold retail investor is a reliable, recurring fee-generating customer. Watching where money flows isn't prediction. It isn't speculation. It's just observation and then acting on what you see rather than ignoring it. The opportunity right now in commodities, in infrastructure, in defense, in the AI build-out, it's real, it's documented, and it's currently priced into the stocks of companies most people have never heard of. The question isn't whether this rotation is happening. The data shows clearly that it is. The question is whether you're positioned on the right side of